All right, Paul. So explain the different types of reinsurance.
Okay. Now, reinsurance is insurance companies insuring each other. And they're reinsurance companies, that's all they do is insure insurance companies. They do it two ways. One of the ways it's called facultative. And that would be like a policy by policy basis. Now, let's say you're insuring some really big stadium or something that's worth, $1 billion, like Jerry World or something. Well, one insurance company doesn't want to insure Jerry World. It's just too big. It's too much money if the worst thing were to ever happen. And so the insurance company insures it, and then they lay a lot of it off. Or it might be multiple insurance companies are doing it, but it's on a facultative is on a case by case basis, a policy by policy basis, usually because it's either really scary or really, really big. And they need somebody else to help share in the risk with them. The other kind is treaty. A reinsurance treaty can cover a whole bunch of policies, and it could be anything. It's whatever you negotiate. But let me give you a real common example. Insurance companies that write homes on the coast, they will typically every year enter into a treaty with one or more reinsurance companies to insure their risk of hurricane losses. And it might say, we will pay the first $25 million worth of hurricane losses if it's a named storm, which is kind of an important distinction for named storms. And then the reinsurance company would pick up after that. Now, what's interesting is the reinsurance company then could have their own treaties with another reinsurance company that says, we'll pay the first 100 million after their 25 million, and then you pick up after that. But the treaties last a full year. It's a contract, and the terms of the reinsurance are laid out in the contract. It could be for almost anything. It could be car stuff, it could be home stuff, it could be big commercial stuff, but it covers big classes of risks that the insurance company wants to push some of it off. Typically it's done too because it allows the insurance company to write more customers. You say, why would it do that? Well, because the regulators of insurance companies, they get real uncomfortable if you grow too fast. And so if you're growing, you can lay some of that off with reinsurance and they go, okay, you're fine, because they're worried about you going broke. And reinsurance is a great way to keep insurance companies in business when bad things happen, like hurricanes and hailstorms and things like that.